All right. Well, I think we're going to get going here. We're still populating, but it is 8:32. So let's get rolling. So I want to welcome everybody for joining us this morning for our economic outlook. We're excited to have Brian Gottlieb as our speaker this morning. I do have a couple of housekeeping items I'd like to bring up. First of all, just to let you know, this event is being recorded, so it will be available on our website after the program. If there's something you wanted to review, or others that were unable to join us today would like to view it, it will be archived on the Chamber website at concordnhchamber.com, and that'll take place within the next 24 hours. Also want to let you know that you can ask questions, and we would encourage you to do so. At the bottom of your screen is a Q&A button. So all you have to do is click that button and you are able to type in a question. So you can do so anonymously, or you can, put your name on there. It doesn't matter. We're going to handle the questions at the end of Brian's presentation. So please do think of questions you would like to ask, and we will accommodate that. Big shout out to Eversource for being our sponsor for today. Eversource has been a tremendous supporter of the Chamber, lots of philanthropic organizations, and they are really a champion for economic development in the state of New Hampshire. They put a lot of effort towards building our state economy. So thank you, Eversource, for your support. So at this point, I'll introduce our speaker, Brian Gottlieb, who became director of New Hampshire Economic and Labor Market Information Bureau back in 2019. And prior to that, Brian was principal and founder of Polycon Research, based out of Dover, New Hampshire. For more than 25 years, Brian has completed research projects for the energy, financial services, telecommunications, real estate, legal, lobbying industries, think tanks, chambers of commerce, higher education institutions, government, and economic development organizations in New Hampshire and in 30 other states. And so prior to founding Polycon in 2001, Brian was vice president of fiscal and economic policy at the Business and Industry Association of New Hampshire. So Brian, welcome. Thank you for being here, and we will turn this over to you.
My pleasure. Thank you for the invitation. Happy to be here as always, Tim. I will say that this presentation, don't need to take notes. I will make it available. I'll send it to Tim, and you're welcome to have copies of it. The other thing I'd like to say is that I have a number of slides. I always have too many slides, so I'll go through them fairly quickly. Some I'll spend a little bit more time on, but I'll probably go through them too quickly, so we'll try to leave time for questions as we progress here. So I'm going to start out sharing my screen here, hopefully. Let's make sure we can do that. How are we doing? Can you see it?
Looks good.
All right, terrific. Okay, so I'm going to, in case I lose you folks, I want to give you kind of the Reader's Digest version of my overview. I just have become more optimistic over the last month or so. My assessment of where we are and what the outlook is for 2023 has kind of changed almost on a weekly basis as new data comes out. But I'm increasingly feeling as though it's possible for the U.S. to avoid a recession in 2023, but it is going to be uncomfortably high risk of recession, and 2023 is not going to be a great year regardless. I do have to say, this is really a unique time in my professional career. I do not recall as many people and as many economists or business people being as pessimistic as they have over the outlook for the next year. And from my perspective, we are really overly glum. Economists are generally trained to look for potential downturns and what's the next shoe to drop. And media folks love to report stories, negative stories. And I think that's just dominating what we're hearing. And there's nobody really paying attention to some of the positives that are out there. So I'll try to focus on some of that. There's not any, from my perspective, or there's very few imminent signs of a recession. The economy is moving along. The labor market is very strong. And there's a lot of things that are indicating to me that we're not likely to head into recession anytime soon. One, household finances are generally better positioned than they have been in prior to past recessions. It's a good indication that we know prices are high and there'll be a downturn, but households are a little bit better positioned to withstand that for a period of time than they have been in past recessions, even though they're spending about $400 more each month because of higher prices. That's particularly problematic for lower income households, but upper income, middle and upper income households enter the recession or potential recession pretty well off with higher savings rates, better balance sheets. So I think it allows us to sustain spending, consumer spending, better than in prior downturns. Inflation, really good inflation report this week. It's moderating, still way too high. And importantly, I think, and this is data nationally that I look at, rents are starting to decrease. And that's a big portion of consumer price index is shelter costs. That takes a while to work its way into the consumer price index because contract rents adjust on a yearly basis. So it takes some time for that, for a number of them to enter the survey. Labor force recovering, not as fast as we would like in New Hampshire, and job growth is slowing. Hard to say that slowing job growth is good news, but it's good news from the Federal Reserve's perspective because they want the labor market to slow. They're very concerned about a hot labor market that will cause wages to rise or to continue to rise, which would fuel additional inflation. So that moderating wage gain will really help ease some of the Fed's inflation fears. A big reason, and this is maybe one of the biggest reasons why I think 2023 is not going to be as negative as many portray it to be, potentially, is that businesses are, I believe, are going to be loath to lay off workers. Now, we've got some very high profile layoffs in the tech sector. You know, we're hearing Meta and Amazon and a lot of digital companies that are laying off. But that's not unexpected. Those are companies that hired en masse during the pandemic. You know, much of our lives shifted to the digital world. So they hired excessively during that time. As the pandemic has eased, as we spend a little bit less of our lives digitally, they're laying off. And I don't want to be crass here, but look, if an engineer or a programmer at Meta loses their job, they're unemployed for as long as they want to be unemployed. They would find employment in no time, re-employment in no time. Households, I mentioned their balance sheets are better. Their debt levels are relatively low, again, with the exception of lower income households. And I'll show you that. So they're entering any potential downturn in a better financial position. Corporate debt's also relatively low. Consumer spending. Now, if we were really in an imminent recession, we'd start to see consumer spending really drop off. It has slowed some, but it has not dropped off. And if consumer spending is not falling and not dropping off dramatically and going negative, and if businesses aren't laying off en masse, there'll be some layoffs, then it is really, really difficult for me to see how we'll have a recession. So that's the big picture. So let's look at a couple of indications of where businesses and people feel. One, and I say this all the time, recessions are fundamentally about a loss of confidence. This has been one of my concerns, is that we can talk ourselves into a recession. So much pessimism, so much gloom out there. And these are two measures. One, University of Michigan Consumer Sentiment Index measures how people are feeling about the economy, and this is my preferred measure to the consumer, the more common consumer sentiment indexes that are produced by the Conference Board. This one does a better job of measuring how households feel about their personal circumstances, where the Consumer Confidence Index by the Conference Board does a pretty good job of measuring, or a better job of indicating what's happening in the labor market. So people felt really bad. It's bouncing up. It tends to turn down the most when a couple of things happen. When gasoline prices rise, that tends to depress consumer sentiment index. the Consumer Sentiment Index, and when food prices, and those are the two most visible prices. So as those prices have risen, sentiment has declined. It is on the uptick. Gasoline prices are easing. Business, the National Federation of Independent Businesses, they're a little bit less pessimistic, but and I think a more realistic assessment of where the economy is going. I pay attention to that because it's a pretty good relationship with hiring trends in New Hampshire, and even though it's a national index, tends to do a pretty good job of tracking how hiring and how employment growth is going in New Hampshire. So we're not in a great spot in terms of sentiment. And again, my concern is we could talk ourselves into recession. We don't have a New Hampshire sentiment index. One of the things I've done during the pandemic is that government, and I work in a government agency, but our data comes out with a lag and it doesn't come out with a high enough frequency. So I look for additional measures, most of them in the private sector. And one of them that I look at to get an idea of sentiment is Google searches on the term recession. When people search Google on the term recession or recessions, that tends to be an indication that the economy is turning. They're more concerned about their own circumstances or the national economy. And here is what's happened since 2020. And you see, as the pandemic hit, searches on recession increased dramatically. Now going into 2022, what you see is it peaked up after the Russian invasion, oil prices spiked, gasoline prices spiked, and as that eased, concerns about recession have fallen significantly. Still elevated, but certainly in a better position than it was 6 months ago. I mentioned that one of the things that I feel positively about is how households are entering any potential downturn. This is the household financial obligations ratio on a quarterly basis. Most recent data is the second quarter of 2022, and those shaded areas are recessions. So if you look at the far right, you see that household financial obligations are relatively low compared to time periods when we were entering recessions in the past. So if you look at 2008, Great Recession, household financial obligations were much higher. Financial obligations are what their household expenses that can't be avoided: mortgages, rents, and insurance, things of that nature. So households are in a better position right now to withstand any economic downturn. Another good sign that we can avoid a recession, or are avoiding a recession, and certainly not in a recession, is what's happening with retail sales. Retail sales fall off, certainly during downturns. What we see here is, again, an indication of what has happened as a result of world events. Again, when did retail sales start to fall off? In particular, it was in March. That's when the Russian invasion occurred. That's when prices started to rise dramatically, gasoline prices, and it continued to downturn, although it didn't go negative. And I have two lines here. Blue is all retail sales, but I also include retail sales excluding automobiles, because automobile sales has been difficult. There's been very low inventory. And then as interest rates rose, that also further have dampened demand. But again, no negative change in retail sales, which is really a positive. And all indications is that the holiday season will be fairly strong. I mentioned CPI moving in the right direction, and this is just an indication. This is the overall consumer price index, the blue line. The Federal Reserve prefers the PCE. Most of you may not have heard of that. Personal consumption expenditure deflator. It's my preferred measure. They're measured differently. I think the PCE does a better job. I don't want to get in too much into the weeds here, but the CPI measures price changes in a basket of goods and services, typical basket of goods and services that people buy, and they adjust that basket of goods and services every 2 years. Well, we adjust what we buy much more frequently that, and the personal consumer consumption expenditure deflator adjusts on a monthly basis. So when the price of beef goes up, we buy less beef and we buy more chicken, and the PCE captures that. And I'll skip the whole definition of core. Core is just price changes absent energy and food prices, because they tend to be very volatile, move up and down quickly. Again, I should say my forecast for inflation, it's going to take a while to come down, but I think by the end of 2023, it'll be around 4%, maybe a little bit under. I think it will be middle of 2024 before we get down to that 2.5, somewhere between 2.5 and 2 that the Federal Reserve wants to see. Again, looking for real-time high frequency indicators of what's happening in New Hampshire. There aren't a lot of them. We don't have a sales tax, so we can't check almost on a daily basis what's happening with sales. One of the things that I look at on a regular basis is seated restaurant reservations, and that's data that I can look at on a daily basis. This data goes through December 12th of this year. And that data is produced by OpenTable. They take restaurant reservations and they started doing this during the pandemic. They compare the number of seated restaurant reservations where people actually sat, as well as walk-ins at restaurants in a state. They have a steady set of restaurants that they compare. And this compares how this year's seated restaurant reservations compared to 2019, so prior to the pandemic. And what you see here is really good indication of the strength in New Hampshire, is that restaurant reservations are up more in New Hampshire compared to 2019, same day of 2019, as they are in Massachusetts and the US overall. Big dip there in earlier in this year in New Hampshire, the red line. And I've been asked about that, and I attribute that to the fact that we had a lot of closures. Restaurants were not open as often, labor shortages, and I think that's what explains the decline in reservations during that time period. But again, a positive indicator. One of the things that falls off during a decline in the economy, or during an imminent decline in the economic strength, is that restaurants tend to get hit. People dine out less. At least that doesn't appear to be happening at this time in New Hampshire. Other positive news: New Hampshire's recovered at least in number, all of the private sector jobs. This is a chart that shows all 50 states and how close or they are to recovering all of the private sector jobs numbers that they had in prior to the pandemic. So New Hampshire, this goes through November, because I have November New Hampshire numbers. I don't have November numbers for every other state, so it's a little bit misleading. We may see Maine jump up a little bit more there, but the key point here is that New Hampshire is performing better than all of the other New England states, and for the most part, all other northeastern states, New Jersey being the closest in terms of recovering the jobs. Other positive news, and this is really good, solid data. Business openings in New Hampshire by quarter, again, through the second quarter of 2022. We saw a decline in business openings. This is administrative data. These are companies that file with our unemployment insurance fund, so they have to register, pay unemployment insurance taxes. We knew it would decline during the pandemic. Not a great time to begin a business or locate a business. Bounce back up after the pandemic. The shaded area there is the worst of the pandemic. And I expected it would fall. It did fall some, but it's remained very elevated. We're seeing a lot of business activity, and that's reflected in what's happening with the Unemployment Insurance Trust Fund. So a lot of entrepreneurial activity, a lot of small businesses, a lot of professional services, but still an indication of the vibrancy of New Hampshire's economy. Labor demand is slowing. This is a chart that shows the job openings rate. That's the businesses are surveyed on a monthly basis. How many job openings do they have? The percentage the job openings rate is basically the number of job openings divided by the number of openings plus the number of people employed. That rose dramatically after the pandemic. New Hampshire had stronger job openings rate than the nation overall. It's come down, but it's still extremely elevated. But the fact is that job growth is slowing. Again, this is one of those situations where bad news is considered good news, at least from the Fed's perspective. They want to see job growth slowing. If you look back, I challenge anybody who's familiar with job growth data to look back at the national data and find a period of time where we're consistently adding over 200,000 jobs month over month. We're averaging now, we were earlier in the year, it was 500,000. Now it's been around 250,000. That's just by historical standards, unprecedented. And it can't last, so it needs to come down. It needs to come down to help wage growth slow. And the Fed wants to see this to gain confidence that we're not going to get into a wage price spiral. New Hampshire has slowed more in terms of job growth. Look, 2021, New Hampshire had job growth that was substantially better than the US average on average. It's slowed more in New Hampshire. This is private sector job growth. I focus on that because New Hampshire's public sector tends to distort the overall job growth numbers, particularly local government, which tends to shed workers pretty significantly. So I focus on private sector job growth, and that's because that really reflects what's happening in the economy. We've slowed more, and we've done so not because our economy is weaker, but because we are more labor constrained. And I'll show you some indication of that. This is a measure of the unfilled job openings rate in the state. Basically, it looks at that job openings rate that I showed you, which was up around 6%, and compares it to the job hiring rate, how many people are hired as a percentage of the openings and the number of people employed. And where that gap is bigger means there's more unfilled jobs. And you see New Hampshire, which should be the red line, it looks like an orange line here, has a higher unfilled job openings rate than the US. Both are extremely elevated, which indicates how tight labor markets are everywhere, but they've been tighter in New Hampshire than they have been anywhere. Not anywhere, but on average in the US. And that's really gets at our big challenge. The big challenge, not just in 2023, but moving forward is our labor force. And this is a measure, it's an index number, so I could put both the US labor force and New Hampshire labor force on the same scale. And the index measure, so it measures the change in labor force from pre-pandemic peak. New Hampshire's labor force peaked in November of 2019 in terms of numbers. The national labor force a little bit later than that. And so compared to that period, November of 2019, we're about 1% below where we were in terms of the number of people in the labor force. US has basically regained the numbers despite having a lower labor force participation rate, and that's because population increased. So working age population increased, even though the participation rate is lower. They've regained all of them. Still below trend line though, trend line growth. I think I'm going to skip this. This is, well, I won't skip it. Very nerdy. I do not like the unemployment rate. If you look at the unemployment rate, nationally of all 50 states, you'd think Vermont had one of the best economies in the nation. It does not, even though it has one of the lowest unemployment rates. My preferred measure of how tight the labor market is the employment to population ratio in what is called the prime working age demographic, age 25 to 54. Those folks are people who are in the labor force in very high numbers, percentages, and generally are, if the economy is going well, they're employed. When I look at this graphic, New Hampshire, the red line, the US, the red line, New Hampshire is at full employment from my perspective, when the employment to population ratio in this age group is about 85%. And if you look at past periods of time, looking at post Great Recession, 2010, it took about 6 years to get back all of the jobs that we lost during the Great Recession. Just prior to the pandemic, we were at much higher employment to population ratios, very tight labor market. There was no slack in the labor market. Pandemic comes, there's lots of slack in the labor market. And what has happened is that we have not regained that level. So we're not at full employment. There are a lot of people still on the sidelines. So when we talk about an unemployment rate of 2.4 or 2.6 like we have now, and people say, oh, there's nobody out there to hire. There are people out there to hire. They're just not looking for work, or they're not in the labor force. And that is our fundamental challenge, to get those people back. When I look at who's out of the labor force, who's not currently in the labor force, this chart compares the difference in labor force participation rates by age compared to pre-pandemic levels. And it's a 12-month average because it helps smooth out the 1 month variation. So what we see is that young people in particular are out of the labor force more. I'm not sure, I'm convinced it was true during the early parts of the pandemic and post-pandemic period. A lot of those people were employed in industries that were hardest hit: hospitality, retail. They received pretty generous unemployment benefits. They received stimulus payments of $4,000 per person. And so I think they took some time off. Now, that hasn't changed. They haven't come back, at least by this metric. And I have to think some of that's related to them doing gig work that, from their perspective, isn't considered looking for work or in the labor force. And that's a little bit of a little bit difficult to work through right now, but there's something happening there. And it's an important demographic. When we look a little bit older at the 35, 39, and even 30 to 34, a lot of that is related to things like childcare, and it tends to be affecting women more than men. Upper age groups stepped out of the labor force in large numbers during the pandemic. Health reasons, also retirement accounts look better. They felt more comfortable. They are coming back. That 60 to 64 age group, right after the pandemic or peak pandemic, was 6 or 7% below where they had been prior to the pandemic. I think, higher inflation and retirement accounts that don't look quite as comfortable have had a lot of people unretiring. But this is a challenge. And I'm starting to run late here. This is what would happen in terms of the number of people in our labor force if we had pre-pandemic levels of participation. That won't happen, by the way. We had very high pre-pandemic levels of labor force participation. We won't get back to those levels. But if we did, and we applied that to the current number of people in these age groups, we would have about 18,000 more people in the labor force. We're about 8,000 down from where we were pre-pandemic. We won't get 18,000 people back in more people in the labor force, but if we could get 10, 12,000, that would make a big difference in our economy and the ability of all you business folks to hire. Good news, we had big increase in movement into the state in 2021. This is just shows 20 years worth of net migration, net state to state migration, more people moving in than moving out, or more people moving out than moving in. 2021, because of the pandemic, people's desire for less density, remote work opportunities, big influx into New Hampshire. Great for our demographics, potentially great for our labor force, although in numbers it will help increase. A lot of those people may be working in other states. That's fine, because the demographics are a big challenge. The big challenge that we face there is that puts tremendous pressure on our housing market, and we have not built enough to accommodate that. So moving forward, it'd be wonderful to see that many people moving into the state, because we grow and our labor force generally grows as a result of movement into the state. Even better news, some of you may have seen me having shared this in other settings, but New Hampshire had a big percentage increase in population of 25, 29-year-olds. Fifth highest between 2015, 2021. Second highest if I cherry pick data and go back to 2014. Very much against the narrative that New Hampshire has one foot in the grave. We have become, I think, much more attractive. I've tracked demographic migration trends for over 20 years, and I can tell you that traditionally the people who moved into the state were a little bit older, families with children, likely two-wage intermarried couple families with kids. That demographic has been moving down in terms of age structure, and this is really good because we have very low birth rates, so we really need to see a movement of young people. We will always lose some of our native people to young people to other states. That's happened for 50 years. It happens in all rural states, but the fact that people are finding New Hampshire attractive younger folks is really encouraging demographic news. They've tended to be concentrated in certain areas. My message to a lot of communities: do what it takes to get these younger folks, and Concord, by the way, is doing it. Rental housing, quality rental housing in the downtown area is one of the big factors. There's a straight line relationship between that availability of quality rental housing in a downtown area and the percentage of millennials in New Hampshire's city's population. So, got to wind up here. This is not my final forecast. I'm waiting for some additional data, benchmarking data on what really happened with employment in New Hampshire before I make a final forecast. But this is my preliminary forecast, and I think 2022 will end up somewhere having added about 2.8% to job growth. A little bit of a reversal to 2021 with the U.S. having greater job growth, and that's again not a weaker economy in New Hampshire, but the fact that we're more labor constrained. I think 2023, over 60% of economists are assuming are forecasting a recession. Some have ridiculously high probabilities of a recession. In my view, I'm holding to the possibility, a very real possibility, that we can avoid a recession, but it will be a slower growth year, no doubt. Again, as I said, I think inflation will wind up being somewhere around 4% by the end of the year. I think U.S. GDP growth will be somewhere around 1%. Our unemployment rate, U.S., will be around 4%. New Hampshire's unemployment rate is always lower than the U.S. It will rise a little bit. We're just at 2.6. And by the way, New Hampshire's rose last month by about 0.2%, and that creates a lot of concern. But it rose for the right reasons. 60% of the people, of the increase in the unemployed in New Hampshire, were people who were re-entering the labor market. Yeah, people think all unemployment is people who lost their jobs. Well, it's not. It's people who don't have a job, who are actively searching for work. And the big increase over the last couple months in New Hampshire, going from 2.2 to 2.6, has been the result of people re-entering the labor force, and that's a very positive thing. With that, I'll stop. I did want to make a point about electricity rates, and I know Eversource is a sponsor here. One of the concerns I have is the energy price shocks in New Hampshire, and I've done some estimates of that will shave some of the growth. Heating oil will cost about $300 million more this winter for New Hampshire families. Electricity costs will add to that, and we're looking at potentially, between all of the energy costs, of almost $1 billion more in 2023, and that will reduce some of our job growth. And with that, I'll stop and we'll have questions.
All right, thank you, Brian, and happy about the optimistic look at where we're going here, and that's good news. So good, around the holidays to hear some positive feedback about the economy. Got time for a few questions. One of them kind of philosophical, but it touches on that. Is the overly gloomy attitude that you describe among the experts potentially a self-fulfilling prophecy?
Yeah, absolutely. And it is, as I said, recessions are at their core a loss of confidence. I mean, there's certain factors that can, shocks that can throw us into recession. Oil prices at 130 or $40 a barrel could throw us into recession. But more fundamentally, it's about confidence. So if people feel especially gloomy, then they stop spending. Right? Consumers, 70% of the economy is consumer spending. If they're particularly gloomy, they don't spend. This holiday season, we'll get an idea of that. And businesses stop hiring or start laying off more. So I think the news has been dominated by pessimism. You hear Jamie Dimon at Chase talking about, an awful economy, and you hear well-known economists talking about possibility of recession. That begins to invade our psyche. And so even if people are still employed and they're earning, we know earnings have been up despite the fact that inflation has been up. They stop spending and they stop hiring, and that's the problem. And we wind up self-fulfilling prophecy. So I'm the town crier of good news, because I really want us to avoid that.
I think it was Jeff Bezos that I heard a month or so ago, sort of recommending people hang on to their money. Just, well, which is not necessarily good for the economy.
And the last guy I want to hear that from is Jeff Bezos, maybe Elon Musk. Those are the two people, and Warren Buffett, who I certainly listen to more than those other two.
Well, just remind folks on the call that at the bottom of your screen, there is a button, a Q&A button. If you have a question, you can type that in either anonymously or leave your name on there, and we're happy to address that question. I've got a couple more. In one of your screens, you had indicated that New Hampshire was leading New England in the recovery, that we were ahead. Can you give some ideas why that might be? What makes us different?
Well, I mean, I think we entered we entered the downturn or the pandemic with a stronger economy. I mean, we have as particularly our northern New England neighbors are really challenged more demographically than New Hampshire. We kind of get lumped in with Vermont and Maine, but Vermont has had a declining labor force, out-migration. Until the most recent year, they had out-migration for about 10 years. Maine has more demographic challenges. And what we've seen is kind of a vibrancy in innovation in New Hampshire. If you look at the manufacturing sector, we've had really strong growth in things like the medical fields, medical manufacturing, pharmaceuticals, industries like that. So more advanced manufacturing, not necessarily a lot of extreme job growth, but those industries spur other activities. We have a situation where people were moving into the state more. That was a benefit to all of northern New England. People left the metro areas in Massachusetts, Connecticut, even some in Rhode Island. So I think it's a combination of the demographic forces, people moving in, saw that 13,000, as well as the mix of industries that we have. And there's some public policy, I have to say, Tim. Some states were less responsive to opening their economies, or less willing to open it. I think New Hampshire managed it very well. I mean, we put the restrictions in pretty severely when we needed to, but we were also willing to open up and let the economy function more normally in a more, from my perspective, appropriate time. And I think we benefited from that. So I think, for instance, I think Massachusetts is still suffering from that. And you saw that in the restaurant reservations data, one of the indicators. I think we've managed it very well.
I think that's a really interesting point you just made, because as we sort of moved away from the really strict restrictions and mask wearing wherever you were, I became accustomed to, hey, we're beyond the mask wearing thing. And then I'd leave New Hampshire and I would be scolded, hey, where's your mask? So caught off guard a little bit.
Yeah.
Hey, another question has to do housing.
Yeah.
We are in a very, very tight housing market. Anecdotally, throughout the state, there are a lot of new construction projects taking place.
Yeah.
What do you see in terms of the value of housing?
Yeah.
What do you see?
Critical. Absolutely critical. I mean, it is very much interrelated with my outlook. It is operating now as a constraint on our ability to grow. I showed you the increase in migration into the state that challenges, our ability to accommodate those people if there aren't places to live. The issue is fundamentally about supply. We've just simply, I have a whole presentation on this. We simply have not built enough. And I'm an iconoclast here. I'm sure will upset somebody. We haven't built enough because we have focused almost exclusively on affordable housing, and that raises red flags in communities. The fact is, if we build anything, we will have an impact on prices and costs, rental costs. We're in a situation where rental is particularly a problem, and it's a problem because there's more people compressed in the rental market. We had a big influx of people forming households, millennial generation, Gen Zs, older Gen Zs. They start moving into the rental market, setting up their own households. The other end, people who would normally be moving out and buying houses haven't been able to do that, either because of prices or because there wasn't anything to buy. So we put this big bulge into the rental market, and haven't built enough, so that's driven up rental price. So we build anything, we take some pressure off of that. So I'm a big believer in build anything. Yes, if you can build affordable housing, that's great. But if you just build things, it will take some of the pressure off prices. And if we don't do that, we are not going to accommodate that increase in population, in migration, which again has been for 3-4 decades has been the key to New Hampshire's labor force growth, is people moving into the state. Often they're, skilled, well-educated. Oftentimes they bring their families, children. So we have low birth rates. So we import our children, and that's good. And so housing is a critical cog in that ecosystem.
So a couple more questions, Brian. Do you have any insights on how the younger demographics are able to still sit out the labor market,
Yeah.
considering inflation
Yeah.
and
That I have speculated on that because it has bugged me early in the post-peak pandemic period. I don't know if we're in a post-pandemic period, if we ever will be. I said those folks cannot stay out of the labor market for 40 years. They got 40 years of working, just like the rest of us. They got to get in there and do it. But they stayed out because they got a lot of money, a lot of income support. Again, $4,000 plus, by my calculation, so many young people are employed in a few industries. They're employed in hospitality, it's their first job, or retail, recreation jobs. Good first jobs for a lot of folks. Those folks, because those industries were hard hit, got unemployment benefits. Feds offered $600 and then $300. By my calculation, 75% of the people collecting unemployment benefits in New Hampshire during that $600 period were making more unemployed than they were employed. I'll be honest with you, if I were 25 years old and the feds had given me $4,000 over the year and I was collecting $800 a week for not working, I'd have socked away a little bit. I'm taking some time off, and I think a lot of people did that. Now that support has run its course. I think what's happening is that young people are finding ways to work that are not W-2 wage and salary jobs. There's a lot of gig work out there. There are people who get paid to play video games online. Now, when a federal agency calls and asks, are you in the labor force? Do you have a job? Are you looking for work? I think a lot of those people answer no. I think they answer no because if any federal government, Bureau of Labor Statistics or Census Bureau calls and asks if you've got a job and you're not getting a W-2, you may be reluctant to say, no, yeah, I'm working. And I think nobody's looked at that, but I think it's playing some role. There's no rational reason why. And when I look at changes in income levels, that many people should be out of the workforce. I think it's a measurement issue as much as anything else, although I do think it's a reduction. But I think some of it's a measurement issue. There are people doing things to earn money. The question shouldn't be, do you have a job or are you in the labor? Is somebody paying you? Are you earning money doing some activity or service. And that's not how we ask that question.
Interesting. So another question, any insights into the reasons why there is increased millennial migration into New Hampshire? We're set apart again.
Yeah, no, I think that's I think partly a lifestyle thing. I mean, generally young people gravitate to, metro areas, more likely to gravitate. They like to be around places where there's lots of other young people. And I say this all the time, for whatever mating rituals they engage in, they constantly go to big cities. I think part of it is, one, remote work. Lifestyle is playing a bigger role in people's decisions on where to locate. There's more opportunities for remote work. I think New Hampshire, finally, a lot of our communities are understanding, and I think Concord's a perfect example of this. Concord is offering things in its community in terms of social amenities, cultural amenities, recreational amenities. I mean, the downtown of Concord is much more vibrant than it was when I first worked in Concord 20 years ago. And I think there's more communities that are doing that. My community, Dover, where I live now, started with the availability of quality rental housing in the downtown area. It attracted younger individuals who wanted to be able to walk to, eatery or, whatever, a place where they could have a drink and socialize. And so I think as more communities are offering that, we're starting to see these communities becoming the kinds of places that young people like to, and there's an agglomeration effect there. Once it starts and people start seeing more younger people, very few younger people want to go to a place where there's no young people. And I think communities are starting to understand that and offer that. And they're starting to do things like develop rental housing in their downtown areas that allow walking to those kinds of amenities that young people like.
Well, Brian, that wraps up the questions that we had. Thank you so much for this presentation. That was terrific information, and thank you for your willingness to share those slides with anyone who's interested. We can send out an email to folks and make that available to them. And also a shout out again to Eversource, our sponsor for this morning's event. We're very grateful for their contribution in helping to make these types of programs possible. So, and thank you all for joining us this morning. It's great to see you. We have lots of upcoming events in the chamber. Check out our website and you'll see a whole list of things coming up that I'm not going to waste your time with now. Check that out at your convenience. Brian, again, thank you so much. We really appreciate it.
My pleasure, Tim. Always happy to come talk to you folks.
Well, we'll come back again and knock on your door once again.
Great.
Thanks, everybody. Have a great day.